produzione Corax, social media company.
Welcome back to The Bull, your personal finance podcast. Aside from a few giants like Warren Buffett and Eugene Fama, the person most frequently mentioned on this podcast is probably Cliff Asness, the legendary former student of Fama himself and founder of the hedge fund AQR, the third largest in the world. Why is that? First, AQR is the firm that perhaps better than any other has managed to bridge academic financial theory with a real-world application. Second, Asness and his extraordinary team produce an impressive number of papers, which at least in my case have probably contributed to about 50% of my overall understanding of finance. In many episodes, I told you that come what may, and even at the risk of getting hit with a restraining order, sooner or later I would manage to bring Asness here with us. At long last, this dream has come true, and the long conversation we had, rightfully earning the title of the longest episode in the history of The Bull, adds immeasurable value to this podcast. So, even though you will never listen to this episode, thank you to Cliff Asness for this incredible honor. And thanks to all of you, because without your presence and without being so many, this meeting would probably have remained just a mirage. With Cliff, we have talked about his years in Chicago under Fama and French, about why markets have become less efficient over time, about momentum and value, expected returns, trend following, and much more. So that, without further ado, I'll leave you to my conversation with this extraordinary figure in global finance, Cliff Asness. Enjoy the episode. Cliff, thank you so much for being here today with us.
Oh, I am happy to do it. Happy to do it. Thank you for having me.
Oh, you're gifting us an incredible privilege by attending our podcast. You can't know it, but I've mentioned you and AQR's work so many times here that you already belong to this podcast without even knowing it, and long before your first appearance today.
Okay. Well, that's a little frightening, I got to tell you, but it's nice to hear.
1 year ago, we hosted here your Grandmaster Gene. So it's kind of a serendipitous occasion to have you here right today. Somehow the stars have aligned.
Well, he is the Grandmaster. So you're very lucky to have him. He doesn't do many things like that.
Yeah, it was truly remarkable. If you don't mind, I'd like to start right from there. Would you tell us about your days in Chicago in the 80s and 90s? Because back then you had the opportunity to study finance where modern finance was born.
Yeah, I mean, whenever something works out well, you got to admit you got lucky, at least partially. Few things have no luck involved. And just I started the PhD program in Chicago in 1988, and it was the late 80s and early 90s when Fama and French were really starting what today we might call factor investing. I always laugh because we didn't have these terms back then. You always use today's terms to describe the past, even though, I don't even think we called like the price to book the value factor immediately. I'd have to go check exactly when that started, but I'm going to guess their first few papers didn't. So I got lucky. I was there. I got to work with them. I got to be early in something, and that is a lot of luck. I don't think anyone, and certainly including me, at that point thought, "Oh, this is going to develop into a major part of the investment industry." So yeah, it was phenomenal. And it's not just being there, it's studying with those two men. Eugene Fama, I remember I actually wrote a fair amount, not all of it, but a fair amount of my dissertation on what today we call the momentum factor. And I remember being very nervous about telling Gene, I want to write on this, because everything can be argued, but it's not a very efficient market kind of factor. Some people can try to make an argument that maybe this works for an efficient market reason, It's hard. And I think I mumbled, I want to study this price momentum factor, professor, and it works very well. Because if it didn't work very well, that is a Chicago Eugene Fama dissertation. Because a lot of investors, a lot of, Wall Street looks at things like momentum. So to be able to write, tons of people claim to be outperforming, but a momentum really doesn't work. Just would have been beautiful. It would have been like, stop splits aren't a miracle. It would have just fit in perfectly. But I said this to Gene, and his response, which I had feared, his response was, if it's in the data, write the paper.
Yeah, sure. Yeah, and I know the response. Great.
One thing you learn from both Gene and Ken is not that data should drive everything, theory and intuition, and you have to avoid just overfitting, but their respect for data, their willingness to acknowledge, Fama's many times called momentum, I think he calls it like the key embarrassment to the 5-factor model, or something close to that. So it doesn't matter what you like. It doesn't matter what result you want to see. Respecting the result you do see is something I hopefully learned. I know those guys have it. I hopefully learned it too.
Yeah, I admit that when Fama came here last year, I tried to ask him about momentum, and his answer was, it's not convenient.
He's honest about it, and their model forms like the scaffolding for modern finance. It's hugely important, but no model is perfect, right? So, I admit I've written.
Yeah. Some are useful.
Yeah, I have written that I think they should include momentum as a 6th factor. You're allowed to disagree while still admire. But, Gene's quite honest about it. So I've always appreciated that.
Momentum is a challenge for the pure efficient market hypothesis because, as you mentioned earlier, it leans more toward the behavioral side when it comes to explaining the factor premium behind it. Now, my question is, in hindsight, what was incomplete in the strong efficient market hypothesis view, in your opinion at least?
Well, I'd like to even back up a little bit. The pure efficient markets hypothesis, even Gene, I don't think he'd say markets are perfectly efficient. I think sometimes people overstate it, and they want to, if someone believes markets are close to efficient, they'll paint Gene as more extreme than he is. I sat through his introductory first-year PhD class 3 times, once as a student and twice as the teaching assistant. I went to every class because I was terrified to get something wrong. And sometime after teaching what the efficient market hypothesis is, Gene shocks the class by saying markets are almost assuredly not perfectly efficient. Because Gene is brilliant and sane. Perfection is a silly hypothesis. I think Gene probably thinks they're more efficient than I do these days. I think I probably think they're more efficient than the average day trader, to go to an extreme. So I don't think most of us who are paying attention and trying to get the details right would have ever argued a pure efficient market hypothesis. I do think, and I know you know the literature well, in the ridiculous amount of years since then, I make a lot of comments about how old I feel when we go over these 1980s kind of stories. 37 years ago when I first met Gene, it's a long time. But in that period, a lot of empirical and theoretical results have tested. And you accurately talk about an efficient market explanation versus a behavioral one. We're still fighting about almost all of them. Right? There's always going to be a story in one direction. You have to make a judgment on each one, which explanation makes more sense to you. And I think you're right. Momentum is not impossible, but is much harder than some of the others. To tell in an efficient market, if a characteristic says this portfolio of, say, 1,000 stocks around the world should beat this other portfolio or does beat this other portfolio, there are always three possible reasons that can be true. One is accidental and overfitting. It just happened. It's not going to happen again. Someone wrote a paper on it. If you get past that, and I think, certainly this is self-serving, but I think things like the value effect, the momentum effect now have such overwhelming evidence in so many places. I don't give that a lot of credence, but you always have to have that one. So if something is real, it can work in an efficient market sense because those things that outperform are riskier, and you got to get paid for taking risk. And we could go down a rabbit hole of how to define risk. That is not simple either, and is part of the issue. But the other reason something can work is someone's making a mistake. It's not that these 1,000 stocks are riskier than these other 1,000 stocks, or the portfolio of them, to be more precise, is riskier. It's that on average people overpay or underpay or something like that. And I do think, again, to your point, momentum falls. It's very hard to come up with something other than a behavioral explanation for momentum. With, say, value investing, I think it's closer to it's a closer battle. I admit I've drifted more to the behavioral side over my career, but it's still an interesting argument. It's not a gimme either way.
Yeah, definitely. Last year, you wrote a widely cited piece, The Less Efficient Market Hypothesis, where you claim that markets have become less efficient over time. Long story short, you do feel markets are still pretty efficient, at least for the average investor, but not that efficient as they used to be. Could you please walk us through all of that?
Yeah, sure. First, I hope Gene's not listening. I'm still scared of him when I say these things.
Do you still feel guilty for trying to beat the market?
Yeah, that was in my bio for a while. I don't know if it's still there. I'm scared that I'm trying to beat the market because Gene's going to yell at me or something. Let's go back to this idea that everyone who's thought about it would agree, I think, that markets are not perfectly efficient. Once you accept that kind of simple concept, two questions. How inefficient are they? And does this change through time become legitimate, right? If things are not perfectly efficient, you don't know how inefficient they are, and the idea that they will always stay the same amount of inefficient strikes me as kind of silly. So what I've observed over my career, and I admit doing this stuff live and suffering the slings and arrows of some periods where some of these factors we're talking about were not rewarded. That is actually kind of a mild way to say viciously punished. Two periods in particular, what's often called the dot-com bubble in the late 90s. I say often called because if you just call it the dot-com bubble, you're kind of giving away the story because you're using the bubble word, not a good Eugene Fama word, right? If you think it was a bubble, we wrote a lot on this at the time, and we revisited it over the years. If you take the basic Fama and French value kind of work, and you could do much more subtle versions of value than just, book to price, but you see the effect no matter what you look at. A strategy based on buying cheap and selling expensive got crushed for about 18 months. 2.5 standard deviations, 3 standard deviations kind of crushed. Not 10 standard deviations. We're not talking about Nassim Taleb Black Swan. We're just talking about a really ugly period. And one thing we did way back then, and we were the first to do this, at least publicly. You never know if tons of people did this privately. So I don't want to, steal anyone's credit. But all of the academic work we had seen up to then just sorted stocks on valuations and asked the very interesting question. Do low multiples beat high multiples? Are there better or worse ways to measure this? But at least to my knowledge, to that point, no one had asked about how different the pricing was. You can imagine let's keep it simple and just do Fama French price to book. Again, I think most people, including us, certainly measure value a little differently these days. But if you sort stocks on price to book and go long the low multiples and short the high multiples, we thought a pretty interesting question was, how different are the multiples? Does that change through time? And does that have predictive value? And what we found was, well, first of all, let me say the incredibly obvious. If you do this sort, the expensive ones always look higher multiple than the cheap ones. I like to say your spreadsheet is broken if that's not the case. I mean, you did the sort. But the ratio, I'm doing this from total memory. The price for Fama French's construction on price to book, if you did that sort, it kind of varied between 3 and 6 over time. Meaning the top third, which is how they usually slice it, of stocks that were more expensive as a portfolio, sometimes were about 3 times the price to book of the cheap stocks, and they got up to about 6 times. At the peak of the dot-com bubble, they got up to, again from memory, about 12 times.
Yeah, that's crazy.
Nothing similar had ever occurred before in like 50 years of data. It was one of these embarrassing graphs. I hope everyone can see. I'm drawing a graph on my fingers now. It kind of did this, whoo, and so clearly something was going on. Either you could tell an efficient market story where our measurements were missing something, that the world had changed, or the world had gone nuts. We also showed in that paper, which we still believe today, that these things are very hard to time, and I wouldn't bet my life on it. Even a few years ago, I called it sinning to time these factors, and then I said you should sin occasionally and modestly. But we said, over the whatever years of data, long-term data we had, that in the 3 to 6 range, when it was more extreme, value did better over the next few years, and vice versa. I think you could have an efficient or a behavioral story, that one. And so we said at 12, it's looking pretty good. And that did work out. I did think that was a bubble. I didn't think that was an efficient market story. I wrote a piece called Bubble Logic in early to mid 2000.
Great call.
I don't know how to define a bubble, but here's my definition. If I can't come up with assumptions that are in the ballpark of what I think are realistic, that justify these prices, I'm willing to use the B word, the bubble word. And in my view at the time, on very diversified portfolios, I would never use the bubble word. I think some people are promiscuous in how they use it. I wrote about this in 2012 in the Financial Analyst Journal, by calling a single stock a bubble. You might think it's very overpriced or something, but for me, a bubble also has to be a market-wide, pervasive thing. It has to be about diversified portfolios for me, and it fit the criteria. But if you had asked me way back then, so roll forward the next few years, 2003, 2004, I'm bragging now, but we turned out to be right. The round trip was actually quite profitable for us, even if we did not enjoy the first. That 18 months of horror for value was also a month 2 through 19 of my new firm. So it was not a lot of fun to have one core part. Momentum was, of course, pretty good over that period, but not nearly enough to offset the disaster that was value. We did make these arguments that it's going to be great. It did turn out to be great. The round trip was great. But if you had asked me after that full round trip, do you expect to see anything this crazy in your career again? Thank God no one asked that, because I think I would have gotten it wrong. I think I would have said highly unlikely. This was the most extreme event in 50 years. The question in your career has a built-in assumption that you and people of your cohort are still around, right? And if you're still around and survived, you're probably closer to in charge. So how is it going to happen again when you all saw this happen once? You're the senior people now. And so I would have said, nah, very unlikely. And then it happened again. Even pre-COVID, So we're talking about maybe late 2019. That same kind of measure, again, done simply on price to book. But as we wrote, there's lots of stuff on our website. You can have many different measures that are more diversified. We got to very close to tech bubble differences with value suffering in a very similar way. And maybe this one is exceptional, but then COVID hit and it all got way worse. We blew past the tech bubble extremes in terms of the spread between cheap and expensive.
Yeah, remembered back then.
There was that kind of stupid 6-month period where the only stock you were supposed to own was Peloton and Tesla. And that was not pleasant for people who systematically want to take advantage of the so-called value effect. So it did happen again. And we survived it. We actually ended up net making money round trip, but it was extremely unpleasant for a while. So separately, we think we've made our process more robust if this happens again. Even if we didn't, we love our process. It worked, but it was not an easy thing to live through. It was not a fun thing to live through. So after the second time, the old cliche, fool me once, shame on you, fool me twice, shame on me. I got fooled twice. So shame on me. It made me go, what did I miss? If there were two bubbles in my career that were unprecedented in the prior, again, call it 50 years, what did I miss? Why? And then I started accepting, again, the empirical fact, which some might dispute, but I think I lived through two things I would call a bubble that were more extreme again than things in the data prior. I started saying, why? And the paper I wrote called the less efficient market hypothesis. Again, I'm not saying they're grossly inefficient or easy to beat or just less than they used to be. First, I wish I could fix something in the paper because this is what I had in mind, but I don't think I was as clear in it as I could be. You always want to rewrite part of a paper. Even I actually try to avoid reading old papers and don't take this personally, I don't tend to listen to podcasts that I'm on because all I do is think, I could have said that so much better. The only time I listen to a podcast is if I'm going back on the same podcast again. Then it's mandatory to say, I don't want to tell Ricardo the exact same stories I told him last time. But I did start asking why, if markets aren't perfect and are prone, what I should have said more in the paper is I don't necessarily mean they're less efficient every single day, but they are more prone to these bouts of again, if you believe, as I do, that these were bubbles of craziness, you got to start asking yourself why. And in the piece, I hope I'm very forthright that I'm conjecturing here. We have 2 episodes. I like to joke, as human beings, we see too many crazy episodes in markets. As statisticians, we see far too few. Give me a few hundred bubbles of similar magnitude. Maybe I can start telling you something statistically reliable about them and start really hypothesis testing what caused it. 2 is not a very large N to run tests on, but they did happen. So I basically have a few, but I had 2 of my 2 favorite hypotheses, which I do believe in. I'm soft selling it here. I'm trying to admit that I cannot be certain they are guesses, but I do believe in these guesses. The first is a very well-known one, the rise of passive indexing. I'm not a passive hater. There are people who think passive is just Satan, and has ruined markets.
Yeah, I know at least one.
I know more than one. Some of them are brilliant people. They just are really, they're quite extreme on it. I think passive has still been an incredible enhancement for the average individual. Jack Bogle and his like are heroes to individual investors to be able to get the market premium for no cost. But we all know I think anyone who's thought about this, I think would agree. Let me say it that way. The whole world doesn't know this. We can't all be 100% Jack Bogle market cap style passive. Jack Bogle agreed with this. Like you, we had a podcast for a few years. Because I don't know about Italy, but in the United States, I believe legally everyone must have a podcast at some point. Well, maybe we'll start this again one day. It was kind of fun. But some of them were internal stuff, but we also had guests. And I was extremely lucky to get to know Jack very well. And he agreed to come on our podcast. And that was a little bit of an odd couple thing, right? Long, short, levered hedge fund quant, and Mr. Passive. But we actually agreed on a lot. And he came on and we got into this discussion about, the whole market can't be passive. And Jack absolutely agreed with that. He thought, and he's probably right, that for the marginal investor, where we are today, the move to passive is still a good one. But he absolutely agreed it can't be 100%. Jack was a very intellectually honest guy. And I asked him, so Jack, what fraction could it be? And he says 85%. And I'm like, that's fascinating, Jack. Where'd you come up with that? And he says, I made it up. Because no one knows. And the point, which I think Jack was trying to convey, and I'm trying to convey now, is we know the market gets really weird. It's even hard to think about what everyone being passive would look like. Literally, no one's thinking about prices. Who says the Magnificent Seven are worth more than the corner drugstore if literally nobody is doing it? Passive is a free rider. Passive free rides on people doing the work. If everyone tries to be a free rider, you get a perpetual motion machine. So I think we know at 100% passive, finance people like me love to steal analogies from physics because it makes us feel smarter. So I call this a singularity, a black hole. The regular laws of physics break down. We don't know what 100% passive looks like, but we know it's really weird. And it's unlikely that all of the weird happens between 99% passive and 100, right? So if you have fewer people thinking about what stocks are actually worth and more people trying to free ride on those who do, the idea that prices could be at least a little less tethered to reality and a little more prone to these episodes strikes me as pretty reasonable. Again, passive is awesome. I don't know exactly where we are on that curve where things get weird, but just the hypothesis, I know we have a lot more passive today than we used to. It's hard to even count how much. There's direct passive. That's not that hard to count. But, what about what are called very low tracking error portfolios? If you're doing that, then you're mostly passive.
Yes, because most of them are closed indexers.
So we know passive is, yeah. We have much more passive than we used to, so I think that's a contributor. But that's not my actual best guess. Sorry, go on, please, Ricardo.
Yeah. Sorry, I just wanted to ask you a question about it before you move to the second hypothesis for the markets being less efficient. Am I wrong if I claim that under the Grossman-Stiglitz paradigm, the market should always be in some kind of equilibrium? Because too much passive investing, whatever too much means, should create more opportunity for active investors to outperform the market, which in turn would lead to a reduction in the overall market's passive share. Is that right?
Yeah, I think there is some truth to that. But a few things. First, I love to steal a term from Ken French, and I'm still not sure if Ken came up with it. I think he modestly says he stole it from someone else, but I forget the origin story. But the term I got from Ken was there's an efficient amount of inefficiency, which I kind of love. In that, it's just a pithy way to sum up what you said. That there may be inefficiencies, but people will take the other side of them. They'll reduce them. But, it's still a paradox, though, because nothing gets away from the old sharp arithmetic that the average can't beat the average. I shouldn't say that. One of my partners, Lasse Peterson, has written a paper arguing, and I think he's right, that new issues that are not in the index, maybe a little end around, But I don't think magnitude-wise that makes a big dent in the Grossman-Stiglitz paradox, which I think is deeply tied to Sharpe's arithmetic. We'll never have a case, X the loss in new issue, a small part. We're never going to have a case where the average active manager wins. And I mean, by the average active manager, I don't mean any particular class. I don't mean mutual funds or ETFs. I mean anyone deviating from market cap weights. If you sum them up, for everyone overweight something, there's someone underweight.
Yeah, definitely.
When you want to argue about it, more opportunity, and people should come in and make it go away, you have to argue that there's a set of informed and less informed investors. It's still, the sum of them is always going to equal the market. But there certainly may be times when, and maybe these bubble times, I would argue these bubble times that I call a bubble, are times like this where the rewards to being the active person going forward, it was usually at least a little painful to be the active person getting there, because bubbles don't occur in a day. And usually you're not these things are fine till March of 2000, which was the peak of the dot-com bubble. If anyone was smart enough to do no value investing until then and put on a huge value bet that minute, more power to them. So, I think you have to get into, are there times where certain classes of investors, and there's an inherently arrogant act. Being an active manager is an arrogant act because it says I am going to be on the right side of Sharpe's arithmetic. Grossman-Stiglitz paradox might hold, but there are losers and winners, and I'm going to be the winner. I am, in fact, that arrogant. But to be honest, arrogant there is just honesty. Anyone trying to beat the market is saying the same thing. So I do think there's this ebb and flow. When things are crazy, here's how I put it. Again, accepting, which I know some would argue with, that there are these bubble periods, accepting that when they're occurring, there are always two problems with doing an active strategy. And I would sum them up as what to do and sticking with what to do. And the second one is something, maybe doing this in real life with investors, with other people's money who are going to yell at you, gives you a little bit of a different perspective than when I was just writing papers on this stuff. So if you accept that there are these times that things get really irrational and there are bubbles, they are easier to identify. By definition, almost a bigger extreme is probably easier to identify. They are harder to stick with. These two episodes that I use as my prime examples, one was 1.5 years and one was 2.5 years. To a statistician, that's not that long. To a money manager in real life, particularly 2.5 years, it's an eternity.
No, it's eternity.
It's an eternity. Exactly right. Sometimes I talk about behavioral time and statistically valid time having a big disconnect. Now, to be honest, managers like me whine too much about this stuff because we certainly don't want a perfectly efficient market. If we believe a fair amount of what we do works because of behavioral biases, a perfectly efficient market, which again is a logical absurdity, but a perfectly efficient market also means there's nothing to do but take extra risk. And maybe there is some of that to do, but a lot of what we do we think works because of behavioral. So everybody who thinks markets are imperfect and there's money to be made, what we all really want is big episodes of crazy that we do that magic thing I referred to earlier, and somehow don't suffer from. But as soon as we put the so-called trade on, the market kind of hits its head and goes, Cliff Asness is right, and just gives me their money. And it doesn't work that way. So if the market is more prone to these crazy bubble periods, and I've given you one of my two stories for why, it will be easier at those times to go, well, this is crazy. We're just looking at these numbers. But it will be harder to stick with. It will be harder to stick with because the losses you incur on the way are bigger, and last longer than they have in the past. And one kind of aside that I could be wrong about this. Maybe some theoretician will tell me, no, that's in my model. But every theoretical model I've looked at, utility-based, what can you... I have not seen duration of pain in them. It tends to be about levels of wealth. I've not seen a ticking clock in those. And again, as a real-life money manager, you can make up the numbers, but I would rather 1.5 times the magnitude of a tough period, a so-called drawdown in returns for 6 months, than 2/3 of that 1.5 over 3 years. Over 3 years, you're going back to your investors at the end of year 3. And our longest has been about 2.5. So we glimpsed this, never seen 3. But at the end of 1 year, especially if you have a reputation, you've done well over time, your investors are pretty calm. They're like, all right, it's a bad year. If you're not Jim Simons with the Medallion Fund, everyone has a bad year occasionally. At the end of year 2, you're getting the side eye pretty hard. You're losing some investors. At the end of year 3, which again, thank God I've not quite had to live through, but I've glimpsed. Even though in these cases, you are more ex-ante right than you used to be. You tend to be suffering in these from the same things that have gotten you there after year 1 and 2. But that's part of the problem. You go back to an investor at the end of even of year 2, which I have experienced. It's the same story you said at the end of year 1. And you're basically saying, well, it happened again. And in fact, it did. And it is better going forward. But there are all kinds of weird things happen. There are a lot of agency problems in our world. You might have been hired by a team that likes what you do and understands it. But if you're having a second bad year, you're often not even talking to them. You're talking to their boss who didn't hire you and might be brilliant, but has no idea what you do. You might end up, God forbid, you're talking to the corporate treasurer. So the staff of the pension fund hired you. And 2 years later, it's like, this is ugly. You should be talking. They don't cut you a lot of slack. So I think duration, sorry, it's a long rant. But I think I'm way too old to do the math on this. But I think a model that includes duration of pain is an interesting one. It may be exactly proportional to magnitude. It may not be. So yeah, I think markets have gotten crazier and I have a few theories as to why.
Yeah. Okay. If I'm not wrong, your second guess as to why the market has become less efficient has to do with stuff like gamification of trading, market noise induced by social media, and other things of the like. Is that true?
Yeah, absolutely. I know on this one, I'm going to turn 60 next year, so I'm obsessed with age these days. I sound like a really, old man yelling at people to get off their lawn kind of thing. It's the kids with their social media and their apps and whatnot. But again, you always got to start with, if markets aren't perfect, if they're prone to occasional bouts of extremes, something it has to be driving it. And markets are voting mechanisms. They're not really arbitrage mechanisms. Ken and Gene have a great paper on this, on tastes and disagreements. Others have talked about it. Go back to that example where there's a mispricing. And there are uninformed investors doing something silly and informed investors taking the other side. If there's a mispricing out to here, and now I'm holding up my hands to demonstrate a mispricing, and let's say that's fairly gigantic and diversified, and you can build a portfolio that, you don't know when, but you're highly confident you're going to make a lot of money on. Arbitrage capital comes in it doesn't have to come in instantly. Maybe it's over a year or two, which is taking the other side of this extreme, and it starts to lower it. Now imagine it's half the size. Okay, now it's half as attractive going forward. Still, maybe an attractive trade. It's not brought it all the way back to what I would call fully rational, but it's brought it halfway. So there's only half the money to be made, and it's riskier. For anyone who has put the trade on already, adding more to it is crazy. At that point, it's half as attractive and you already have a lot of it. So markets, as long as there's a net error being made that isn't accidentally offset by an error on the other side, errors are risky to take the other side of, and they get less risky as they get arbitraged down. So they will not be taken to zero by rational investors. They'll just be made smaller in general. So markets are a voting mechanism. You vote with your dollars. It's not a fair world. Warren Buffett gets more votes than I do, and I get more vote than the average investor gets because more dollars can move prices by more. But you vote with your dollars. And this is the closest I'll come to politics, Ricardo. It's not a safe topic for anyone these days. But what I think most people, not everyone again, but most people would agree with is this environment of social media and the whole milieu that people kind of swim in. I think it's fairly safe to say it's made our politics worse than it used to be. I am not as familiar with Italian politics. I'm going to guess there's some similarities. But in the U.S., this idea that people live in their own informational bubbles, that social media enhances confirmation bias, that the algorithms in social media, and in things like YouTube, I wouldn't quite call that social media, but it's all one big ecosystem. The algorithms are known to push you to more extremes. So if you started out believing, this thing, they keep pushing you to believe something more extreme. And, I'm not taking a side here. I'm just saying I think it's made our politics worse, more prone to extremes in both directions. If markets are just voting mechanisms, why on earth would they not have had a similar effect, at least directionally? Again, I can't put a magnitude on these things. I can't tell you how this compares to indexing. I could tell you my best guess is this is the biggest part, but it's a pure guess as a market observer. It is not a quant thing. So I'm out of my comfort zone when I'm taking guesses like that. But when you don't have data, that's all you got. Gamification you mentioned. I think there are a lot of so-called retail investors who are having fun. And I don't think it's, again, sounding like a nasty old man, I don't think it's an accident that this has grown up, at least in the U.S., at the same time as legalized sports betting. I don't think people on their phones, on the Robinhood app, where, you do the crazy thing everyone else is doing and it works for a while. And every time you buy, confetti comes down on the screen. How that looks very different than, I'm betting on whether this basketball player makes this free throw. Am I an elitist who thinks a lot of these people are not really doing deep research, that they're punting out there? Yeah, I got to tell you, I kind of am. They might be very good at things that I'm incompetent at. So it goes both directions. But I do think this environment has been, if not a steady state problem, making us more prone to extremes. I could cheat and point to the biggest extremes. And now that I said cheating, I will do it. The meme stocks in the U.S. I think the world has largely avoided quite our degree of crazy on this. But the meme stocks in the U.S. are kind of the extreme example of what I'm talking about. Almost completely social media and online trading driven phenomenon that I think is pretty clearly irrational. It's not fair to point to the most extreme thing and say you've proven your point. But do I think that's a point on a spectrum and the rest of the market has moved to more meme-like, or at least more prone to meme-like investing? Yeah, I got to tell you, it might be a sin. And Cliff Asness 1990 might yell at 2025 Cliff Asness for it. But yeah, I think it has. And all of this, one thing that I started to get to, but I didn't quite finish on this, Grossman Stiglitz, some part of the market is taking the other side. of irrationalities. If my hypothesis is right, which I keep telling you, got a lot of huge ifs here, those times when it's easier to identify but harder to stick with is actually kind of a weirdly fair thing. And I think about Ken French's efficient amount of inefficiency here. When the market has these bouts, there's more money to be made for the rational investor. I think it's, again, a definition. Go to the other extreme. A perfectly efficient market, there's no money to be made. We want inefficiencies. Like I said, we whine when they get too big. We want them to fix themselves right after we put them on, but we want inefficiencies. So if I'm right about this whole thing, any kind of rational investing, and we ourselves, by the way, have tried to diversify our process so we're not quite as dependent on the world doing the right thing as we used to be. But any kind of rational investing, it can be Fama French, it could be, old style Graham and Dodd investing, where you're looking at not just price to book, but a set of multiples against growth, against moats, against risk. Any kind of rational investing, if you can stick with it, will be more lucrative. You'll make more money long term in a market that goes crazier, but that if looms larger, because it is harder to stick with. And in a weird way, I think this is oddly fair. There's very rarely free money being handed out. If it's going to make you more money long term to do, and it was not harder to stick with or even easier to stick with than it used to be, then it probably wouldn't even get here to begin with. It would be too easy. So I do think we have this balance where the market is probably prone to some more extremes. That's a very good thing if you are on the good side of rationality there, and if you can stick with it, with, again, a big if to the second part.
Yeah. Nowadays, there's a huge debate about at what point of the cycle we found ourselves with those very high bubble-like stock valuations, although fundamentals seems better now than those back in 1999. Anyway, though it's hard to make predictions, it's always important to make capital assumptions about future returns, in particular of this seemingly late-stage secular cycle. Cycles have a mix of rational and behavioral explanation behind them. You can see here Antti Ilmanen's second book about expected returns, and you all at AQR did a great job trying to explain and make sense of expected returns. Now, my question is, in your opinion, how much does it come down to rational variation of risk premia, and how much is more behavioral when it comes to explaining why expected returns change over time?
Well, you've given me a chance to give Antti a plug. Antti and colleagues actually have a 10-part series on our website now about forming long-term expected returns.
Yeah, wonderful series.
I am on social media. I announced this morning the 10th, and I think it's the final one. So obviously, Antti's one of my business partners, so you should always discount what anyone says in that direction. But I've loved his work since I met him in 1988, and I think that series is great. I'm partly filibustering here because it's a very hard question to answer. And this debate has been going on forever. When they split the Nobel Prize between Fama and Bob Shiller, Lars Hansen also got a share. I don't like to leave out Lars, but he wasn't. Shiller and Fama were juxtaposed. Lars was kind of doing other stuff. Gene, it certainly did a lot more than this, but I think a substantial amount, and Bob did a ton more too, but a substantial amount of why Bob got the prize was for this notion of excess volatility. And so this debate has been raging forever. And let me sum up this. Fama and French even, this is probably the 90s, maybe in the 80s, wrote pieces saying that there's some predictability to long-run stock returns. I don't want to overstate it.
I think it was 88.
88, thank you. The years, I am fond of saying I remember two periods very well. The last 2 weeks and high school. Everything else is something that has happened to me in a 37-year career. But other people have looked at it too. Price divided by something rational. I think Fama and French in the early papers used the price to dividend ratio mostly. Nowadays, people probably use Shiller's CAPE, cyclically adjusted price to earnings ratio more. There's no perfect measure. You can always get into arguments about whether now is different or whatnot. And statistically, this is a nightmare. Some of my own colleagues have written, and Antti fully acknowledges this, that it's hard to prove this statistically. You just don't have enough, long-term periods. People tend to think about decades, which I think is a pretty reasonable number to where you're not making a short-term prediction, but you're also not making an unconditional 100-year prediction. And, at best, we have maybe 10 decades. And the data quality is a lot better in the second half of that 10 decades. And so it's not a lot of data points, and it's hard to be statistically valid. Some of the early work, I think, using asymptotic t-statistics, kind of overstated. So I think of this as a point estimate. There's 1 point estimate that on average, when you've paid a higher multiple for the stock market, you have made less going forward. When you've paid a lower multiple, you've made more. Remind me if I forget to talk about whether this is useful for trading. That's different than setting long-run expectations. But I think the evidence is, yes, there is some predictability. Again, statistically, I wouldn't bet my life on it. You have to ask yourself, do I believe it? It seems fairly intuitive to me, whether it's a risk or a behavioral story. Famously, valuation ratios capture either. I think it was a paper by Ball like a million years ago. I could be giving credit to the wrong person, though. Again, memory starts to fade, but valuation ratios can be a catch-all. If you raise the expected return on something for either behavioral or risk-based reasons, the valuation ratio changes. So, the Shiller critique of the rational case. The rational case is when the multiple in the market is quite large. It's indicating that the expected return is smaller, but it must be riskier in some sense. It must be a rational degree of variation. What Shiller showed, which I'm not getting this exactly right, it's related to this, is even if you knew the future, you cheated. These were papers I think you wrote with John Campbell, and said, what's the present value of the future dividends today? Cheating, looking forward 10 more years. The actual movement in prices and in that dividend ratio would be far less than what we've seen. Now I can link it. The Fama response, and it's not just Gene, is okay, but rational variation in dividends, in future growth, essentially you're saying, is not the only reason things can change today. If expected returns, required expected returns, vary through time, we'll also see much more variance, because that's what, again, these valuation ratios really are in this case. And figuring out, like right now, the Shiller CAPE is quite high in the U.S. It's not as bad around the world. It's high ever, as I think about 45, 46, and that was during the dot-com bubble. It's, by most people's calculations, about 40 now. So, the historical average is more like 16. So that's an expensive market. It could be that this time it's not predicting returns, that growth is going to be so fabulous that expected returns are actually should be normal or even high now. I tend not to be a big fan. That's the this time is different story. Today, that story would be an AI story largely. AI is obviously going to change the world dramatically. It's obviously there are some super profitable AI companies right now saying it's going to forever change the growth of earnings in a competitive market. I think it's a tougher sell, not impossible. If it is expected returns being lower, by the way, Ricardo, this is all leading up to me saying I can't answer your question. Is it in a rational bubble or a low or just a more savers than consumers out there, willing to accept a lower return on the market going forward. Very, very hard to tell the difference. Auntie's estimates are less extreme than some others who look at these valuation ratios. His core capital market assumptions, and if I told you AQRs, I'm just telling you Aunties and teams. Imagine you see a very high price to earnings ratio, a Shiller, cyclically adjusted Shiller measure. And imagine you don't believe future growth is very predictable. So you do believe that's mostly about expected returns. You can assume one of two things going forward. You could assume that, you could assume anything on the spectrum, but you could assume, hey, these expected returns are rational. People are don't need to earn what they've earned in the past in the market. They've accepted that. Or you could assume that they're making an error. The difference is if they're making an error, you will likely see mean reversion. Over the next, again, 10 years, you really might see that cape come way down. And if it fell in half, negative 50% over 10 years, compounding makes this argument imperfect. I'm going to pretend we don't have to deal with compound returns. Negative 50%, call it 5% a year. That's a huge hit. Imagine the market is genuinely accepting of a lower but positive expected return. And here I mean a risk premium, expected return, expected real return, return over bonds, something like that. If the Shiller Cape is really high because people have finally got the message the stocks are less risky than people have always thought, the stocks for the long run is the right story. And yeah, we don't need a 7% over inflation. We can accept 3% over inflation. Then the good news is we don't need to have terrible returns over the next 10 years. The bad news is the lower average returns are here forever. Because the way returns get restored to normal would be mean reversion, or again, super duper growth for a long period. I don't mean that is not my favorite story, but I don't mean to be dismissive of that. Auntie's estimates tend not to assume mean reversion. He tends to give the estimate where you still make less money, by the way. And some don't realize this. If you pay a much higher multiple and you get normal growth, it's like buying a bond at a lower yield. In fact, it's the same thing. So Auntie's forecasts tend to be a lower risk premium, but not the heroic ones of some famous bears out there. And who knows? Auntie's a very humble guy. He'll tell you they might be right. They have been right in the past. In the early 2000s, when we saw 45, we eventually got back to pretty normal Shiller Capes before we saw crazy ones again. I say crazy or rationally high ones again. But that does bring me to the point of our Auntie's numbers very interesting for an active manager. And I think Auntie would agree with this. Not so much. Imagine Auntie's right and the expected risk premium on equities going forward is positive but substantially lower than it's been in the past for any of these reasons. Well, if that's the case, what do you do in a real life portfolio? Do you underweight equities? Do you short equities? Well, remember, Auntie's forecast is still a positive number. It's just a smaller positive number than the past. And I was joking before about how painful it could be to go after 2 or 3 years to an actual real life investor and say you're underperforming. If you short something with a lower than history but positive expected return for 10 years, you lose money for the full decade. You simply lose less than you would have lost on average over the prior 100 years. I don't think there are many investors who are going to pat you on the back for that one. I still think Auntie's numbers are extremely useful for almost everyone in the market, because almost everyone, be they a pension fund who does this rather formally, or an individual who has a spreadsheet on the essential question is, what do I need to save for retirement? or to be comfortable with this purchase or whatever. If that's important to you, and I would argue that's probably important to most investors, and Auntie is right that you're going to make less in the next decade than you've made in the prior, 50 to 100 years on average. It's pretty important to know. You got to save more if you're going to make less. So I'm a huge fan, of course, of Auntie's work. But he's been very valuable in trading strategies in other ways. When you look at his book you have on your shelf, is that the original expected returns book or the low expected return book?
It's the second one. It's investing amid low expected returns.
The original one gave away too much intellectual property. He's not just talking about market returns. He's talking about things like value, momentum, carry strategies. So Auntie's been incredibly valuable on that side, but his capital market assumptions we use only to advise investors about what we think the next decade will look like. We do not go short a whole bunch of stocks because Auntie says they're going to make less than average. We don't like losing less than average.
With presumably low expected returns going forward, and given that the macroeconomic regime might have changed in 2022 after 4 years or so of declining interest rates and the inflation comeback, now the typical combination of stocks and bonds doesn't seem to be an ideal one any longer. And this makes the case for further diversification in the future. You have written a lot about alternatives in the portfolios, with one of them being trend following. Trend following had a terrible decade in the 2010s, if I'm not mistaken, and a great year in 2020, this year so-and-so. But you are a strong proponent of this strategy, as far as I understand. The question is, would you please tell us about it, why it works, pros and cons, etc.?
Well, first, I got to be honest and say, if I think I have a way to add value that's not very correlated to markets, whether the markets are expensive or cheap, I'm always going to want to add at least some of that. I would readily admit when markets are offering you less long-term, maybe my excitement level about an uncorrelated source of return would be higher, though. So your point's well taken. Trend following, I will differ with you slightly. I would actually not call the 2010s terrible. I would call them disappointing. Most versions made money. They just made a ton less money than the stock market. I don't think most. Of course, there'll be a lot of heterogeneity. I can't speak for everyone, but the way we see it, they had small positive returns, which can be frustrating to stick with when everything else is going up. So it was a very painful decade for the trend following industry. But real life strategies, markets have 10-year bad periods, let alone not making a lot of money over 10 years. But the idea of a trend following strategy, I wrote a dissertation on price momentum. That was for picking individual stocks. So essentially, even though I wasn't thinking of it as a hedge fund strategy at the time, you go long, strong price momentum, short, bad price momentum, or relatively bad. And there's a premium to that. You make money. When it comes to directional markets, stock markets, bond markets, currency markets, commodity markets, we're not going long and short within the market. You're looking at the whole market, typically implemented with futures. Price trend strategies, a lot of it's just vocabulary. It is momentum. The same momentum strategies we talk about in individual stocks. Just for some reason, in what's called the managed futures world or the CTA world, it's called trend following. I cannot explain that to you, but I am as hostage to popular vocabulary as everyone else. The reason we think momentum or trend following works, I said before, we think it's behavioral. Well, we talked about that earlier in the podcast. I think the story, it's hard to come up with a risk story for it. The behavioral stories themselves, there's a little bit of embarrassment here. I always laugh. I actually think it's fine at the end, but it sounds funny. I think the two best stories in academia or for practitioners as to why these trend or momentum strategies work. My favorite story is underreaction, meaning news comes out, prices move in the direction you'd imagine. Good news raises prices, bad news lowers prices. But this famous behavioral phenomenon called anchoring and adjustment. People update their priors, but maybe don't do it enough. So what happened in the market does not reflect the full value. If that's true, be it momentum for individual stocks or for stocks, bonds, currencies, or commodities directionally, whatever has happened in the past, sight unseen, probably has underdone it a bit. So it would lead to it continuing, at least statistically. Right? Certainly not in every place. This is why you do it in tons of different places if you're doing a systematic strategy. The embarrassing thing is the other kind of popular explanation, be it formal or informal, for trend or momentum strategies working can be called overreaction. That it's kind of a more inefficient market, bubbly. Both are inefficient markets. One is underreacting information. The other is what we can imagine in a bubble. When we talk about meme stock traders, positive feedback loops, the market, things go up and they tend to keep going up because money pours in at that point. The hard part is empirically, both can be true. They sound like opposites, but they really aren't. They can both be part of kind of the market structure. And which one is driving things can vary through time. I tend to think underreaction is the bigger part of why either momentum or trend works. And I say works. Whenever I say the word works, I mean like a cowardly statistician. I mean a little more often than it doesn't, so you want some in your portfolio. Now, the interesting thing, so a trend following strategy, the classic way to do it, and I'm going to have to brag a little bit because I think we have improved upon this, but the classic way to do it is in those four big markets, usually based on the last month to a year, go long markets that are doing well and short markets that are doing poorly. Stocks, bonds, currencies, and commodities. Different trend followers can and do fight like crazy about whose system is best. What period do you measure this over? Is it straight returns? Is it a moving average? Is it some more complicated mathematical filtering process? Yeah, but essentially they were all doing similar things, including us for much of this period. Why is this attractive? Two reasons. One is, on average, we believe it works. Sometimes it gets killed, right? If you're a trend follower and everything is great and a meteor hits, there's no trend to follow. So there are hard times for trend following. There are long periods like the 2010s where trends don't pay off as much as they normally do. Even if I would argue it was not a disaster, it required patience. But on average, they pay you. They have paid us over our life of doing, and they've paid us over long-term back tests. That's number one. Number two is this is not a guarantee, and I always want to be careful about this. But on average, again, they've had some of their best periods during some of the biggest drawdowns for mostly equity markets. When the world is suffering, in 2022, you brought up the example that trend following was very strong. It's only one big data point, but it's another big data point that they did their job when you kind of needed them. Again, they're not crash insurance. They didn't suffer, but they didn't really help a lot in March of 2020 when COVID hit. Even a trend following model can't see something that came out of the blue. But those things, we saw how quickly that one reversed. The biggest hits to investor wealth tend to be sustained drawdowns. The biggest change to investor behavior tend to be sustained drawdowns where they can't take it and they cave at the last worst moment. Trend following has historically done particularly well in those environments. So the combination of something that works on average but tends to step up when you need it, we think is an attractive one. In a market today that's more expensive than average and maybe even salty. This ain't as quantitative as I like to be, but where geopolitics maybe scares you more. Having something with those properties Again, to be honest, I'm always going to tell you have some of this because I believe in it long term. And I don't think it is super easy to time when it works or doesn't. But right now, I probably like it a little bit more. With the honest confession that is less pure quant and more just market observer. I did say the world has moved on, particularly our world. How we measure trends has got more subtle. It's not just price. It's all kinds of good news happening, right? If markets tend to underreact, you can look at the prices directly to measure that because on average, they're not going to move enough. But you can also look at the news they're supposed to react to. You can look at earnings for individual stocks. You can look at GDP announcements for global markets. If that's the news that tends to move markets, markets will underreact both in a price sense and to the news. So we tend to measure them roughly 50-50 with both, which is a big change that has actually helped a lot over recent years. The other thing is we do trend following in many more places than we used to. I kept referring to the big four: stocks, bonds, currencies, and commodities. What I also didn't say is most trend followers, including us till maybe 7 years ago, did those mostly in the big liquid places. It turns out there are a lot of more interesting things to do. There are a lot of, for instance, commodities that aren't the big liquid one. They aren't crude oil, but there are many hundreds of them. And collectively, there's pretty decent capacity, and trend following holds up in those. There are structured trades. Traditionally, trend following, certainly, I think every trend follower on earth includes the 10-year treasury or the equivalent in other countries. Turns out, with a little thought, you got to get a little cute here, but with a little thought, structured trades like the shape of the yield curve, the 10s versus 2s in a interest rate sensitivity match sense, they're very amenable to trend following. The individual equity factors themselves, the value factor, the momentum factor, the quality factor, they tend to trend. And if you're a CTA that can trade individual equities effectively, you can capture that. And those more esoteric trends that were not the traditional ones have also, I think, helped those who do them a lot in the post-2022. In 2022, all these kinds of trend following finally paid off after, as you put it, a tough decade. Since then, it's been particularly important to diversify how you think about a trend past just price trend and to do it in even more places, some of the more esoteric places, including more off-the-run securities and more structured trades, have been considerably better than the traditional big liquid ones.
Yeah, from the investor point of view, it's behaviorally challenging because investing in stocks is typically negatively skewed, while investing in these strategies is positively skewed. So most of the time they go meh, and all the payoff is concentrated, which makes a very difficult investing style to bear, at least for the vast majority of the typical investors.
No, exactly. I think everything is difficult in its own way. Negative skewness can be certainly difficult. We used to worry a lot more. Maybe the market's wised up to this a little bit more about people panicking about crashes and whatnot. I think the stocks with the long run argument, buy the dip. I kind of hate that phrase. And my colleagues have a paper coming out soon showing that there's nothing special to when a dip is occurring. But that attitude maybe has made markets more resilient to the negative skewness. But that has been a challenge over time. The challenge with a positively skewed, positive expected return strategy is patience, because there will be long periods, and we think we've made this better with those two changes I've mentioned, but the traditional price trend in the major markets, even if it's as good as it was over the prior 50 years, has long periods where it tries your patience, waiting for that big payoff. And that can be challenging in a totally different way. Again, I always get back to that paradox. I'm thankful for these challenges because if they did not exist, the opportunity would not exist. It's the case almost in any kind of systematic opportunity. If it was the easier it is to do, the more arbitrageable and the more it can go away. But yeah, as to that one, I'll say I think there are ways to make it better where that average return can be better in those fallow periods for traditional trend following. But I would still do, even if you said AQR, you can't do either of these two big things that you've made it better in the last 5 to 10 years. I would still have some traditional price trend in my portfolio. And yes, it would still have that problem of relatively decent length periods where you have to keep apologizing for it.
Yeah. Before you answered the former question about trend following, you mentioned value as a sensible advice, at least in this moment. One thing I learned from you, and God bless you for all the stuff you put out, because we have all learned a lot about factor investing and many other stuff, thanks to AQR's paper. I was saying one thing that I learned is that value seems to work better along with momentum, which is kind of counterintuitive at a first glance because they are somehow on the opposite sides of the spectrum. Momentum implies trend, value implies mean reversion. Would you still advise combining them in a portfolio instead of sticking with only one factor style?
Yeah, certainly. I think I wrote a paper with Lasse Peterson and Toby Moskowitz called Value and Momentum Everywhere. This result was actually very consistent. Neither strategy works all the time. They're fairly negatively correlated most of the time. You get rare instances where they can be positively correlated, like a year after a giant bubble when value's been strong and has momentum. But most of the time, they're fairly negatively correlated. On net, the data in my dissertation, which I wasn't as well thought out. I wasn't thinking of it as I'm going to do this investment strategy, but both value and momentum were in my dissertation. The data ended in 1990. From 63 to 90, that was the full data sample, 27 years. We now have 35 years. Again, you're old when you have more out-of-sample data than you had in-sample data when you wrote the paper. And I would say, by and large, looking globally, I think it's held up better than many think. Value in the U.S. has been disappointing. It's been better globally. Momentum has been good on net. Both have been lower than backtests, but I'm pretty sure we were saying this when we started our group at Goldman Sachs in 1994. No one should expect a full backtest going forward. We've discounted those and said, hey, if we get half this, we're thrilled going forward. And it certainly delivered that. I've written too that I think value even in the U.S. is underestimated a bit. I wrote a piece on our website called "The Long Run is Lying to You," showing even over fairly long periods, if a strategy or a market has gotten markedly more expensive or cheaper, your estimate of how good it is will be off if you're just looking at returns. Because if a strategy has gotten much more expensive, if a stock market, for instance, started at a Shiller Cape of 10 and ended at a Shiller Cape of 40, that's going to make the returns over that period substantially better, even if that's a 30-year period. You don't want to, in my opinion, you desperately don't want to use realized returns over that period. You want to adjust for the fact that you don't expect to see that valuation change again. And while it's well off the peak of the end of COVID, when that spread between cheap and expensive within stocks, the so-called value factor, got to its maximum ever, last I looked, it was still the high 70th percentile. It has not gone back to fully there, to fully average. And that still has a rather substantial negative impact on even 20, 30-year returns. So I don't believe you should expect to get the 1963 to 90 backtest. Backtests will always overstate what you should expect going forward. But I think real-life returns to value strategies since then, particularly in the United States, where those spreads are still wide, probably understate what you should expect going forward because we've still suffered a capital loss on them. The system has made money, and I think it's at least a little, frankly, underappreciated going forward. So yes, I still like value and momentum. When in my life I've strayed from it and been a more pure value person, I've generally lost. And my prime example of this, and I do a mea culpa on this, in late 2019, I wrote a piece saying we always say timing these things are a sin. We're going to sin a little. We're going to do more value than normal given where the spreads were. Here's the logic, and I don't think my logic ex ante was that terrible. Yes, on average, you should wait to see some momentum or trend. You want both. But singular events like a bubble you don't get to bet on the average. You get to bet on the single one. And if you're reasonably sure that these valuation ratios will come back to some semblance of normal, even over 5+ years, you risk missing it. Just because on average something tends to trend doesn't mean this time it doesn't come back really quickly and too quick for trend to pick it up. So at the time, I did think that was a rational bet. I still think I can make a case for it. But I will admit, once again, value plus momentum or trend did better than I did. And we did very well. But value plus momentum, had we waited another year and change to see it start to work, we would have given up some of the inflection point when things started to return to normal. But the round trip would have been better. So once again, I should have listened to my dissertation more. So yes, I still believe in the system.
Yeah. Thank you so much. Great lesson in a nutshell. Cliff, last question, because I'm afraid we are running out of your time. AQR has always built its strategy upon strong theoretical foundations, like academia findings put to work into the real world. But over the years, you have tended to lean more toward data, machine learning, etc., in an effort to balance economic theory and what the data tell you. I suppose AI is going to have an impact on your strategy and on your modeling even further. Would you please walk us through how you balance finance theory and data-driven findings?
I have said this publicly, and it's actually been overstated by some, where I've said, particularly, yes, machine learning. But if historically we were 50-50 theory or story, doesn't have to be a very formal economic theory, but 50-50 understanding why something works and data, that it works. We always wanted both, right? The capital asset pricing model is a beautiful theory. The only risk you should be paid for is market risk because it's undiversifiable. It simply fails everywhere we've ever tried it. So theory alone doesn't get us there. Data alone, I will admit, some, even historically, even before recent times, even giving 50-50 weight to both, you could still take some weight based on purely data. I point to people like us, like even Fama and French, who believe in the profitability factor. I got to tell you a dirty secret. Nobody, in my opinion, has a great story for why more profitable beats less profitable. You can have a tautological behavioral story that people underestimate, for instance, how sticky profitability is. So when you buy the more profitable, it's going to last on average more, which I find plausible, but it's pretty hard to test. The risk-based story, some have tried. I don't buy them at all. The empirical results, including a negative correlation of value, which boosts the attractiveness, certainly, are so strong that even in the past, we would give it some weight. Though probably less weight than if we thought we had a great story to go. So it's always been a combination of the two. What I've said recently is the advent of machine learning, which we're using in a bunch of places. We're using it to create some new factors. When I say new, they're often better ways to measure old ideas. So if we want to see fundamental momentum, can machine learning, through what's called natural language processing, extract a signal about fundamental momentum from corporate earnings statements, earnings calls? I won't tell you how. We publish a lot, but there are limits. But we think the answer to that is yes. We still get a lot of intuition. We think that's working for very similar reasons to why fundamental always works. So we're not doing something that's purely data-driven. But are there steps in the process? I've used the term surrendering to the machines, where we lose some intuition that in old methodologies, we used to get intuition at every step of the process. Yeah, I think so. The way you do this, and I won't get too geeky on it for your listeners. I know, Ricardo, you would enjoy it. But essentially, you're representing every earnings call as a vector of numbers. There's a whole bunch of numbers. And that's what NLP does. And you're then empirically using more standard methods so you can get fancy here too. You're looking at how these vector numbers predicts returns going forward. It turns out that it does a really good job. Nothing is near perfect, by the way. Really good job is just a really nice Sharpe ratio for us. And is correlated to some of the old fundamental measures. So you think you understand what it's doing. It's extracting information from these earnings calls about how is it going right now. And since language is nonlinear and complicated, ML does a better job than some old methods used to do. If you ask me, what's it actually doing with that vector numbers? What do those numbers mean? Then I say, I'm really not sure. And this bugged me for a while. And I've admitted I probably slowed us down by a year or two on some ML-based factors. And I think it's appropriate when you're going to do things that are different, that lean maybe more on data and a little less on either theory or intuition than something that's worked for you for near 30 years. I think it's appropriate to go slow. I've gotten convinced. And I'll leave you with one last way to think about this, because it's a very simple little sentence, but it was eye-opening to me. It's embarrassing because it's obvious. If the ML part of your process if it was all obvious and intuitive and you understood every step, what the heck is the ML doing? If it's doing something that's not very easy to sum up with traditional, call them traditional linear, that it didn't have to be, but methodologies, it's not really doing anything. So the very act of using these things has a little bit of surrendering to the machines in it. Now, where's annoyed me is I've said that, and there have been a couple of reporters who write, AQR is fully surrendered to the machines.
No, of course not.
Points on a spectrum. But yes, I think it's always been some of the two, and enough empirics, like in the profitability factor, we've always been willing to do some. But ML has entailed being willing to have at least some step in the process that maybe we have a little less understanding of than we used to.
Okay. Before we part each other, just an aspirational question, which is the typical one I ask to close my conversation with guests. If I'm not wrong, you have two couple of twins. Is that right?
Two sets of twins. Yeah. Only my wife and I know how to do it.
Two sets of twins. Okay. Of course, the question was not about your family. The question is, if you had to give your 4 kids just one piece of advice on how they should invest their money over the long run, what would that be?
Oh, there are so many of them. I have literally told my kids, if something happened to me, it always gets ugly, right? These stories are always something has to happen to you. Clearly, if AQR is still running, this is arrogant, but I love what we do here. And if my colleagues are still running it, stick with that. But if not, something in between or a combination of a firm like Vanguard and a firm like DFA, yeah, I'm good with that. Of course, being a competitive person, my first choice is us. Also, I don't charge my kids fees, so there's a little advantage to that. I admit that. Any good money manager, which is hard to find to begin with, but if they don't charge you fees, that's a special deal that even my friends won't replicate.
I'll definitely have a very special one.
But all the simple things, if you have no access to the things that I do for a living, stay diversified. You don't even have to do factor tilts. Pure Jack Bogle would be fine with me. But if you find someone good, like my ex-professors, who can do some factor tilts, and then look at it every 5 to 10 years while you raise your family. That's very hard to do, but hopefully they've seen that work over time, so they have a head start.
Cliff, thank you so much for your time. It has been a remarkable conversation, the one I had long waited for. Thank you for making it happen and my little dream come true. Thank you so much for coming to visit us today.
Well, thank you. I appreciate it. This was a lot of fun. You asked all the right questions, and hope to see you soon.
Yeah, I hope so. Bye-bye.